invest in and follow principles. That has proved to be pretty successful.
This landlord's going to make almost $2 million over the next 12 years for doing something one time. And that's like residual. This guy's got another 7 retail spaces and he's got 10 stories of apartments above it. And I'm like, man, I'm on the wrong side of the coin, right? I need to own real estate, not broker it.
You start doing deals that are absolutely life-changing, like that put you on the path for intergenerational wealth.
Welcome to the Real Estate Home Runs podcast. I am your host, Luis Vanderhorst. This is a podcast for busy professionals who want to learn about passive income producing strategies that have helped others crush it in the real estate world. Whether you are a new or seasoned real estate investor, this is the podcast for you. Welcome back to the Real Estate Home Runs podcast, everyone. I'm excited for this episode today. Tom Dunkel is not too far from me. He lives in Wayne, Pennsylvania, and I'm in Reading, Pennsylvania. It's interesting to connect and network with other investors who are doing some impressive things. So I can't wait to have him share. Quick housekeeping item. If you guys haven't noticed, we launched the Outsource My Life agency, where we help busy investors with marketing, lead generation, branding, and virtual assistant services. So make sure to check us out. Check out our website at outsourcemylife.us and see what we can offer. So let's get into today's show. Tom, thank you for joining us.
Yeah, Luis, it's great to be with you today. Thank you.
Awesome. I'm glad to have you here. I learned about Tom through a connection that does matching of good guests and connect them with different hosts. And I was really impressed with Tom's portfolio and his biography. So I'm excited to hear his story and introduce you guys to him and just hear how he got started. So Tom, tell us your background before you got into real estate.
Yeah, sure. Thanks again for having me on the show today. And congratulations on joining the crazy ones of us who escaped our, full-time JOBs to go full-time into real estate. So good for you, my friend.
Thank you.
So I'm born and raised outside Philadelphia and went to college down at the University of Delaware, not too far away from here. And after working for a couple of years, went to William and Mary for my MBA. And so I had a little bit of a roundabout way that I got into real estate. I wanted to get into real estate right after undergraduate, but I graduated, not to date myself too much here, but I graduated from college in 1990 and the real estate market was in the toilet. So I had to, even though I wanted to go into real estate, I got my real estate license. It was just a no-go. So I had to figure out another way. So I ended up going back to business school, getting into mergers and acquisitions and corporate finance. So that was great. I had a fantastic run with that. Was surrounded by fantastic people, learned a ton from Harvard MBAs, Wharton MBAs, Chicago MBAs, just incredible group of people. I was in the aerospace industry, so a lot of these guys were like ex-fighter pilots and stuff. It was a really cool environment. So I got the deal bug there. We were acquiring large businesses, $50 million, $100 million deals. So that was a lot of fun. I was building those financial models and just supporting the valuation of those deals and the financing of those deals. So that was kind of my corporate career. And then 2000 came around. I had then moved back to the Philadelphia area and I was working with a local company here for the CFO. And April of 2006, he said something very interesting to me. He said, "You're fired." So it was actually a great thing because it was the kick in the pants I needed to go out on my own, which is something that I always wanted to do. And it gave me the opportunity to get back to real estate, which I had taken about a 15-year detour through corporate America and corporate finance to get there. But that's a little bit about my background.
Okay. And it's interesting because we grow up thinking that getting fire, it's a bad thing, but sometimes it's what we need.
Absolutely.
So that we can move into what we're called to do.
Yeah, for sure. Yeah, if I had to plan it all out, and I don't know that it ever would have happened. So it was good to kind of rip the Band-Aid off, just go right for it. So it was an interesting time. Married, I had young kids at the time, and it was a little crazy. But I think that's when I learned that I am an entrepreneur. I needed to go out and do my own thing, and corporate America was not for me.
And walk us through that first deal. How were you able to find it, fund it, and what was the exit strategy with it?
Great question. Oh, man. So I probably had the worst possible upbringing to become an entrepreneur because I thought everything was going to be pretty easy, right? Because I had things pretty easy up to the time that I left corporate America. I advanced in my career pretty well. I was making good money. I had the right education. I was around the right people and all that. And so I figured, going out and buying some houses, how hard can this be? Well, I learned very, very, very quickly that it was a lot harder than I had anticipated. So that first deal that I did, Luis, was a disaster. I overpaid for the house. It was a big time fixer upper house in northern Philadelphia, and the roof was leaking and the basement was full of water. And I mean, basically everything needed to be gutted and rehabbed. And I just went into it thinking, well, I'm going to wholesale this. So I'll get it under contract. And then, just maybe clean it up a little bit here and there. And, this is going to be no problem. I'll just, follow the system because I had, done some education about how to go about doing these things. And just nothing went right. It continued to rain. The roof continued to leak. And I think on that first deal, I forget the numbers exactly, but I'm sure I lost like 20 or 30 grand easy on that first one. But you learn, it's a learning experience. So continued to buy and ended up building a little bit of a rental portfolio, which that was a whole other disaster. But I did have some deals that worked out great, where I was able to get a good house at a good price, get it fixed up, get it sold, and make some money. But it was definitely a learning experience those first few years as I'm coming out of the kind of the comfy, cozy corporate America and getting into real estate. And then especially at that time when we were just on the cusp of everything, just kind of going to hell in a handbasket. So I learned a lot and wouldn't trade it for the world because I think it set me up for future success.
That's good. So it set the stage for where you are now, where you're going.
For sure.
Good. And how did you jump into the self-storage space, or that was something that evolved over time? Tell us a little bit more about that.
Yeah, sure. So after kind of dusting myself off and picking myself up after the real estate bubble burst, I started buying distressed mortgages, which was kind of a niche area to be. And around about that time, 2009 timeframe, I started buying those. And I met Joe Downs, who's my business partner to this day. We met at a real estate networking event. So like we were talking about earlier, your network is your net worth. So I was going out trying to find my next adventure. So I ran into Joe, told him what I was doing with distressed mortgage debt. And he said, "I think you're effing crazy." I said, "Well, you're a smart guy. Why don't you go and check out the distressed mortgage debt space and, come back in a couple weeks. We'll meet at the bar." And I know you asked about self-storage. I'm getting there, I promise. And so we met at the bar and he said, "Hey, I think you might be onto something." So we literally sat down and flipped over a paper placemat and we wrote out our business plan for our distressed mortgage debt business, which we still do today. And we've been very successful with that business. We've generated over $50 million revenue in that business. And we've had a nice run with that. And what that's allowed us to do is to get into other things. So along the way, we've gotten into hard money lending. We did do some fixing and flipping of houses once again for a short period of time. And now we've gotten away from those businesses because we're now focused on self-storage, which we discovered around the 2016 is about when we probably first started looking into it, because we did have these other businesses. We kind of spread a little thin. And so we really didn't focus hardcore on self-storage until 2019, because it took us about that long to get ourselves educated, get the right team lined up, because as you got to have the right people around to make sure you're going to be successful. So we were able to bring on another partner, Tim Kane. He's an expert at lead generation, and he came from the residential space. So we took his lead generation engine for residential and we just pointed it at self-storage. And so using virtual assistants and his program, we were able to generate a bunch of leads. And then the last piece of the puzzle that we really needed was an operations expert. So we were able to find a self-storage operations expert, and we brought her on as a consultant, and we still work with her to this day. So it was when all those kind of stars aligned that we were able to really jump into storage, where we spend 90-95% of our time on that business now.
Excellent. So It's a team effort. It doesn't matter
Absolutely.
what we do. Yep.
Yeah, absolutely. Yeah, it's tough to be successful by yourself. And actually, that's what I did when I first started back in 2006. I was like, I can do this myself. And that was the wrong answer. So now I'm constantly looking around for people that I can add to my network or to my team, either my in-house team or my expanded team, and just always looking for better people there, because you find that right person and just things click, and then you're off to the races.
Yeah, awesome. And something that we say here in the podcast often is that we need to find what our superpowers are, finding out what we're good at, and kind of focus on that and bring the people that can complement what we're lacking.
Yep, 100%. 100%, 100% of nothing is nothing. So, you want to be your own person, go for it. Makes it really hard, but bringing on the right partners around you and the right attorneys and bankers and consultants and those people, as a numbers guy and like being responsible for the profit and loss of our company. And I'm always I'm like, oh geez, well that could be expensive, but that was my old mindset. My mindset today is, hey, that's a great investment in getting over that hump so that we can keep moving forward.
Are you noticing any common mistakes that self-storage operators make, or people that invest in self-storage that others should be looking out for?
Sure. Yeah. I mean, just like anything else, I guess it boils down to a couple things. One is buying correctly. That's one of the first things you learn, right? As a real estate investor, you make your money when you buy. It doesn't matter if it's a $100,000 house in Philly or in Reading or a $5 million self-storage facility in Maryland. You've got to make sure that you're crunching your numbers the right way, and you got to stress test them and not just look through rose-colored glasses. We've been through an extraordinary time the past few years where rental rates have just been going through the roof. Our portfolio rental rates last year are up 21%. And obviously it would be silly for us to think that that's going to continue into the future, because that's just really extraordinary growth. So when we're doing our forecasting and our modeling, we're still running our rental growth rates at like 5 to 7%, depending on the market, because we want to be conservative so that when we go to our lender and we go to our investors, we can look at them in the eye and say, hey, we've stress tested this model based on our experience. Here's what we think we can do with this property because it's mismanaged. But, if that doesn't work out, it's still going to be a good deal because we know we can hit these numbers down here. So that's, over the years, that's certainly something that I've learned, is to be conservative with those expectations. And it means that we have to pass on a lot of deals because there's a lot of people out there paying dumb money for properties. And then the other thing I'd say about that, Luis, is operations. I know people in the self-storage industry who are in it, fairly recently, and kind of like back during the .com bubble in the late 1990s, it's like everybody was a stock picking expert because the stock market and NASDAQ and all these new technology companies were just going through the roof. And we've sort of had that similar experience the last few years in virtually every asset class within real estate. And I've met people who are like, they've bought 3 facilities, there are many millions of dollars into this business, and you meet them and they're like, yeah, we got to figure out how to run these things now. It's like, whoa. Talk about putting the cart before the horse. But this is where I mentioned earlier about pulling our team together. We have a transition and operations expert that's been in the industry 16 years. So she's seen it all. She's seen the ups, she's seen the downs, she's seen good deals, bad deals, everything in between. So we bring her on as a consultant early in our acquisition process so that she's another set of eyes to test our modeling, just like the lender is another set of eyes, just like our trusted investors are another set of eyes. We're getting a lot of people to look at our deals as they go forward. But at the end of the day, you got to operate these things. So she makes sure that our data is transferred over from the seller to our system, and we get our software up and running, we get our marketing up and running. We have a finger on the pulse of the market, so we know where we should be with our rates and what the competition is doing and all those kinds of things. So, and going forward into, we're probably looking at a recession in the next, 12, 18, 24 months. I mean, that's when operations is really important, because that's when the tide goes out, right? You can see who's wearing the swim shorts and who's not. So we're really focused on operations and making sure, whatever happens with the economy, the external forces that we obviously have no control over, we're at least controlling what we can and making sure that we're running our facilities tip top.
That's good. And where are you guys mostly based with these storage facilities?
Yeah, so even though you and I are here outside Philadelphia, we actually don't own anything around here. Our facilities are in Maryland, Virginia, North Carolina, Georgia, and Florida.
Okay.
And the reason for that is we're really looking to ride the demographic trends. So, demographics, our area is pretty steady, and there's certainly pockets of neighborhoods here and there and that are popping in our area, and we're certainly looking at those. But in general, the population growth and the job growth and the big investments that are being made in the South and the Southeast. So we're trying to ride that wave because, like we were talking a minute ago, there's certain things we can't control. So the market is one of them, right? We might find a great facility, but if it's in a market that's declining or iffy, or maybe there's a lot of crime in that area, or maybe there's a factory that just shut down, I mean, that's not going to help us. So we look for those areas where there is population and job growth, diversified economy. It's not a one factory kind of town. So we're looking at those kinds of things and the income of the population in that particular market. So we're looking at all those things to make sure that the market is going to be solid for us.
That's good. As you plan ahead and evaluate different opportunities that come through your desk. Yeah, it's important to keep those different factors in mind, because that will tell you if that's a healthy economy there.
For sure. I'd rather own a crappy facility in a great market than a great facility in a crappy market.
Yeah, I like that. I've heard people say they want to buy the worst looking house in the best neighborhoods.
Exactly right.
The same principle, I guess, can apply here.
100%. Yep, absolutely.
So how are regular folks able to participate in these kind of deals?
Yeah, sure. So we do raise capital to buy our facilities. So thankfully, we've had investors, high net worth investors over the years that have worked with us in our distressed mortgage debt business and in our hard money lending business. So we were able to transition some of those folks over to self-storage because we've got that trusted relationship that we've built over time. But we are always looking for new investors. And I think the ideal investor for us is somebody who's professional, they're super busy, they are questioning the public markets, the stock market, bond market, mutual funds, et cetera. They're kind of wondering where that's all going. And they want to diversify into something that's tangible, right? They can really put their hands on, get their head around, but they're super busy, right? So they're not going to be able to do what we do, which is get the virtual assistant in the Philippines, calling hundreds or if not thousands of self-storage facility owners and trying to line up those deals and work with the bank and work with the attorneys and get the environmental done, all those kinds of things. So we're happy that we're able to provide a service to these folks where we can help them grow their money and hit their wealth goals. So we're providing them with growth opportunity, income opportunity, and security, because these are hard assets, right? It's real estate, it's metal boxes with concrete floors and roll-up doors. It's not a complicated business to understand, but there's a lot of value that we've created in our portfolio, and we love being able to do that for our investors. So we just closed an acquisition last week. We raised $1.3 million from our friends and family. So those are folks writing checks anywhere from $25,000 up to $150,000. And so we just have a program with them where we pay a preferred return, and then we have a profit split with them. And we make sure that they're well taken care of before me and my partners participate in that upside, because we want them to hit a really nice return. And then, of course, with real estate, you have the tax benefits of depreciation and those kinds of things, so that we can ideally set up a scenario where they're getting income, they're getting cash distributions, but on their tax form, it's showing as a loss, so it can go against their other income. That's one of the beautiful things about investing in real estate. So we'd like to get to know our investors. So I always encourage them to reach out to me, set up a call. And if they're local to us, Luis, love to meet up and, grab a bite to eat or a cup of coffee, what have you, and just talk about their investment goals. What are they trying to accomplish? Where are they in their wealth building life cycle? And just, get a conversation going. So we've got investors from all walks of life. We've got everywhere from like dental hygienists and hairstylists, we really do, all the way up to engineers and, people who have sold their own businesses for tens of millions of dollars. We've got all kinds of people in between. And actually, truth be told, we've got my mom. My mom is one of our loyal investors, and my brother and sister. and just other friends. So I know some people are a little weird about doing business with their friends and family, but all of our stuff is very thoroughly documented. And we're always telling people, hey, look, if this isn't for you, it's fine. Just, walk away, find another deal. But, we always do everything well documented and attorney reviewed and all that stuff, just to make sure that not only an investor is safe, but that we're safe too, that we're covered. So we just encourage people to, if they like a deal, take a good look at it. And if they don't like a deal, just say no and move on to the next one.
Yeah, that's good. And it's truly a relationship-based business.
Absolutely. And I have to say that we've been really happy with how our investor database has grown, because it's all been organic. And what I mean by that is, we had some trusted people early on that just believed in us and supported us. And what's happened is, those people have had good results, and then they come back, they invest more money, and they bring their friends. So that's telling us right there that they're happy with how we're performing. And one of the exciting things that we've implemented in the last year or so, Luis, is an investor portal. So now everything's online, and that's how we communicate with our investors. We post our monthly reports there. And of course, they can always call or email us. But if they're looking for the latest management reports from the facility that they've invested in, they can go right into the investor portal and click through those reports and see exactly what's going on. So we have full transparency there. And all of our distributions to our investors are direct deposited through our investor portal, if folks want that. I mean, I think most people are, tired of getting checks and taking them to the bank. So we're set up to directly deposit those preferred quarterly payments into our investors' bank accounts. So they like that.
That's good. So what are 3 things that have helped you be successful in real estate?
Yeah, I'd have to say, first and foremost, as I've touched on a few times now, it is the team. It really is. And not just the leadership team, right? It's our support staff, right? We have a great accounting team, and they're generating the accounting reports that show up on our investor portal so that our investors can see exactly what's going on there. We have our managers who are the boots on the ground. They're dealing with the day-to-day operations of the facilities. And man, that is a hard job, and they do it with style. So I really appreciate them as well. But yeah, just the team in general, and our attorney. We have a fantastic attorney out of Philadelphia. And just back to the whole kind of networking thing, we used to play tennis together. I didn't even know what he did for a living. And we got to talking one day after tennis. Turns out he's a real estate attorney. And not just any real estate attorney. He's working on like $100 million commercial real estate deals. And so here we come to him with like a $1 million deal or a $2 million deal. And I'm like, hey, we got this little Ford Pinto deal over here for our, Ferrari attorney. But anyway, he's awesome. So he keeps us out of trouble and keeps everything well documented. And then I guess number 2 would be, you just really be careful with your due diligence. It's easy, especially if it's like a deal being marketed by a broker and you really like it, but the broker's coming back to you. He's kind of creating this auction environment. You're like, oh, I really want that deal. I really got to be able to say no and just walk away from a deal. So what we do, well, first of all, we try to avoid marketed deals. We really try to find deals direct with the owner of the property. But we do look at some broker deals, and we're always just super firm with our numbers, and we do not get caught up in the whole auction thing. And they come back to us and say, hey, this buyer over here is looking to pay this much, and you guys are only paying this much. We say, well, hey, that's our best offer. We've done our due diligence. That's the best we can do. And by the way, here's our track record of closing deals. We're credible buyers. We know what we're doing. It's going to be a smooth transaction. So you might want to go with us instead of chasing the higher dollar guy that might not have as great a track record or might not have the great team, et cetera. So we've actually won some deals that way. We've lost a lot of deals, but it's okay. We don't want to chase those dollars. But yeah, do thorough due diligence and just sticking to your number and not being afraid to walk away, I'd say is huge. And then I think lastly is, maybe it's kind of an extension of number 1, but it really is that your database and those relationships, because without those investors and without those other financing sources, those lenders, I mean, we can't do what we need to do. So, and that's something we've learned over the years for sure is, it's easy to go, well, maybe it's not easy, but let's just say that it's easy to go get a buddy to put up 50 or 100 grand into a deal. What's hard is what happens after that. And we call that capital servicing. So you've got the capital raising, but you've got the capital servicing. And that's where the portal comes into play, because it's that communication, that transparency. Frankly, it's credibility. Like I think we look pretty credible because of what we have set up with our back office. But nurturing those financing sources and just communicating with them, the good, the bad, and the ugly. Everybody knows that not every deal goes perfectly. But if you're open and honest about that, I think it goes a long way, because those folks, they'll come back into your next deal, because the biggest risk that they have, it's not, the roof or the plumbing or the whatever. We don't have that in self-storage, thankfully, but it's not those things. The risk is really in the sponsor. And so if you can get your investor comfortable with the sponsor, that takes just a huge piece of the risk out of the equation, because I've been ripped off before. I've put money in deals with a sponsor that ended up taking the money, even, and if they had just lost it, like if it was just a bad deal, that'd be one thing, but if they just take it, that's a bad thing. So learn from my mistakes in that regard.
Awesome. Hey, how can people stay in contact with you and learn more about what you're up to?
Sure. We are pretty active on Facebook. If you can go to our Belrose storage group page, that's B as in boy, ELROSE, Belrose storage group. That's where we do a lot of posts. We like to share articles that we're finding that maybe are interesting, especially right now we've got interest rates going up and inflation and supply chain issues and all those kinds of things. So I'm constantly out there reading those articles, so I like to share those, and those will be on Facebook. Also, deals that we've closed will be on there, or just other little tidbits. And then our website, of course, everyone needs to have a good website. So belrosestoragegroup.com, B as in boy, ELROSE, storagegroup.com. On there, you can learn more about me and my partners and the team. Very proud to show those guys off. And you can also get to our investor portal through there. And as I mentioned a few minutes ago, our investor portal is where all of our offerings are made. So when we have an offering that comes up, we blast it out to our list that's registered on our portal. And then they can click through there, get to our portal, and they can see, we have what we call an investor deck. So that's the thorough analysis that we've done on the property. It's got the pictures and the maps and the financials and our strategies and all those kinds of things that we're going to do with the property. And we also do a narrated version of that, where I actually kind of narrate through the slides. So I think people like that, because I think you learn a lot more when you're looking at the slides and you're able to hear the story. But whether folks are, interested in self-storage or not, or our company or not, I would encourage folks to come to our website anyway, because there is a free resource there. We don't need your name, telephone number, email. It's just there on our homepage for free and easily accessible. And it's an ebook. And it's an ebook that I've generated just from what I've learned over the years, kind of like we were talking about a few minutes ago, about pitfalls of investing. And it's called the S.A.F.E method, the safe investing method. And SAFE is an acronym, S-A-F-E. So it's S is sponsor. Who's this dude that's asking me for money, right? So you ask all those questions about that person. And then ultimately, the ultimate question is, can I sleep well at night knowing that this person has my investment money? And then the A is for asset. What is the asset that you're actually investing in? It's amazing to me. Sometimes people don't really understand even the asset they're investing in. So like if you invest with us, you're buying membership interests in an LLC that owns a self-storage property. So that's how virtually every self-storage deal or apartment deal that I know of is set up. So you want to know exactly what you're investing in. So folks that are like into Bitcoin and that sort of stuff, I don't know what they're investing in. So I don't know what that asset is. So I don't know. I couldn't explain it to my mother-in-law or my 19-year-old son. I don't think I could explain that. So again, you want to be able to sleep at night knowing your money's tied up in that asset. And then F is for financials. What are the financial projections? What are the financial metrics? And my personal financial situation. Am I putting too much money into this one deal? Because of course you want to spread it around. And then E is exit. How do I get out of this thing? I'm putting up money in a real estate deal. How do I get out of it? It's not like, going to schwab.com and you go click, 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 and you're selling your position and getting your money 3 days later. It doesn't work that way. in our world. So you need to be comfortable as an investor having your money tied up for probably at least 1 year. I know some deals out there that I've seen are 7-year deals or 10-year deals. For me, that's kind of a long time. Our deals are typically 1 to 3 years. We like to keep things pretty compressed time-wise. And that's the SAFE method in a nutshell. But we have a whole ebook in there with lots of questions to answer or ask and get answered. And again, it goes back to the investors that we work with. A lot of them are very busy professionals, very high level in their industry, and they just don't have a lot of them just don't, unfortunately, have the time to, dig into alternative assets and learn everything about storage. So this gives them a framework that what I'm hoping is it'll give them the opportunity to get away from stocks, bonds, and mutual funds. Not entirely. I mean, look, you got to invest in lots of different things, but at least give them the confidence to say, hey, I now have this framework. I have these questions to ask and get answered so that I can get my head around these deals. And you know what? At any point in time, you hear something that just doesn't sound right, you just say no and you move on to the next deal. So belrosestoragegroup.com, get your free ebook on the SAFE investing method.
Awesome. Hey, thank you so much for your time. I really like the SAFE method for sponsor, asset, financial metrics, and exit. Those are great principles to evaluate. And it doesn't seem like other investments you can take calculated risk like you do in real estate.
Yeah, I agree. So yeah, it was kind of born out of, a lot of mistakes that I made personally, but a lot of things that I did right. So
Good. Hey, thank you so much again. And I hope you have a great day.
You got it, Luis. It's great being with you.
We hope you enjoyed this interview and got some value out of it to help you in your real estate investing journey. If you can take just a minute, please do us a favor and leave a review. Hit the like button on iTunes or whatever platform you listen to our podcast on, and subscribe so you can hear future episodes. Also, don't forget to check out our Real Estate Home Runs Podcast Community Facebook group, where you are able to connect with some great listeners. If you're an investor who is crushing it and want to share some information centered around passive income in real estate, please contact us. Hit those home runs, and we will see you next time.